All right, let's talk about something that drives a lot of people nuts. Why does it feel like the stock market is on a completely different planet than the economy the rest of us live in? We're going to break it down.
I mean, you've seen this, right? You turn on the news, the market's hitting another record high, but then the very next story is about layoffs or how small businesses are getting crushed. It feels like it makes zero sense. But believe it or not, there's a reason for it.
Yeah, this right here, this is that whiplash we're all feeling. One headline shouts about soaring confidence, the other talks about real-world struggle. So how can both of these things be true at the exact same time?
And look, it's not just you, I promise. This is a real thing, a genuine economic paradox. But the good news is, it actually has a pretty clear explanation, and that's what we're about to get into.
So here's the secret. The whole thing really boils down to just two simple ideas. First, what the market is paying attention to, and second, who is actually in the market. Let's start with the what.
The easiest way to wrap your head around this is to think of the stock market less like a report card and more like a crystal ball. Seriously, it's not really focused on today's economic. It's actually a massive collective bet on what the world is going to look like 6 months, a year, or even further down the road.
Right. So in fancy economic terms, they call this a leading indicator. A stock's price isn't really about how the company did last quarter. It's a bet on how much money that company is going to make in the future. So when you see the market rally while the economy is in a slump, it's not ignoring the present pain. It's actually pricing in the recovery it expects to see coming over the horizon. Now, let's flip that coin. Most of the economic news we hear, stuff like the unemployment rate, that's what we call a lagging indicator. It's telling a story about what has already happened. It's a history report, not a weather forecast. And that difference in timing, well, it's everything.
Okay, I get it. That sounds a little theoretical. So let's use a perfect real-world example to make it concrete. The Great Recession back in 2009. Just look at this timeline. It's fascinating. The stock market hit its absolute bottom and started a massive rally in March of 2009. But the recession itself didn't officially end for another 3 months, in June. And here's the kicker. Unemployment, the real pain people were feeling, didn't hit its peak until October. That's a full 7 months after the market had already turned the corner and started looking towards the future.
Okay, so that's piece number one of the puzzle, timing. The market is forward-looking. But the second piece is just as important. We have to ask who or what actually is the market. Because I'll tell you right now, it is not the same thing as the economy.
You hear the market's up on the news, and you're probably hearing about an index like the S&P 500. And that's what? Just 500 companies? But get this, there are over 30 million businesses in the United States. That means the S&P 500 represents this tiny, super exclusive club. It's a snapshot of the corporate giants, not your local pizza place or hardware store.
But wait, it gets even crazier than that. Because even within that tiny little slice of the pie, the performance of the entire index is often dragged along by just a handful of absolute behemoths, these superstar companies.
And this is where things get really skewed. See, because of how these indexes are weighted, the performance of just a few of the biggest stocks can pull the entire average up with them. This means you could literally have hundreds of companies in the S&P 500 barely staying afloat or even sinking. But the incredible growth of a few giant tech companies can make it look like the entire market is booming.
And just to add one more layer to this whole thing, these giant companies, they're playing a global game. They're multinational corporations making a ton of their money outside of the US, so their stock could be soaring because of huge sales in Europe or Asia, even if things are slow back home. Their success isn't just tied to our economy, it's tied to the whole world's.
All right, let's step back for a second and put all these pieces together. We've talked about timing, the crystal ball versus the history book, and we've talked about the players, the giants versus Main Street. So what's the big picture here?
So if you remember anything from this, remember these three things. Number one, the market is always trying to predict the future, while economic news is reporting on the past. Number two, the market is a very small, exclusive club of giants. It's not the whole economy. And number three, those giants are playing on a global field, so what happens here at home is only part of their story.
So the next time you see those crazy, contradictory headlines, you'll know exactly what's going on. The market and the economy, they're connected for sure, but they're not speaking the same language, and they're definitely not living on the same timeline. And that kind of leaves us with one last question to think about. If the stock market is just one very specific future-gazing piece of the puzzle,
What else should we be looking at to get a real feel for how the economy is doing today?